Ever wondered how the best traders in the world keep finding winning stocks again and again and again? So turns out most of them follow a framework which has been there for decades, and it's called Canslim. It comes from this classic book by William O'Neill, How to Make Money in Stocks. I highly recommend everyone to read this. And while all these super traders that I have been covering on my channel have added their own flavor to it over the years, the core idea still works brilliantly. Now, instead of dumping all the 7 letters at once in one video and confusing all of us, we are going to take one letter, one video at a time and really deep dive into the concept till it sticks in your head. So by the end of this, all the video series, you won't just know Canslim, but you'll actually be able to use it to find really good stocks and in real trades as well. So let's start with the first one, the letter C. So what does C stand for? So C stands for current quarterly earnings per share. Now, have you guys ever wondered how some stocks suddenly take off while others just sit there doing nothing? It usually comes to one thing: earnings. When a company's profits start growing fast, the stock often follows with a strong move. And this pattern has held true across decades, across industries, across time. So the key takeaway, it comes down literally to this: big earnings growth equals big stock moves. So why does the current earnings matter? So in this book, it's given that when the researchers studied the top performing stocks over several decades, a clear pattern showed up. About 3 out of 4 big winners had quarterly earnings up 70% or more before their big run. And even those that didn't, they usually hit that kind of strong growth in the next quarter. The best companies don't just grow, they show consistent earnings acceleration. Quarter after quarter, profits rise faster and faster. The key takeaway out here is look for companies showing steady, powerful earnings growth. These are the real leaders. Now, another thing is look for EPS, not just the profits. Now, when this book says earnings, it's earnings per share, not total profits or profit before tax. But why this? Why the EPS? Because EPS actually tells you how much profit the company is actually generating per share. That's what belongs to the shareholders. So when you're checking for performance, always look at the percentage change in EPS compared to the same quarter a year ago. So here, please note, we're comparing the year on year, not the quarter to quarter. And this is why most of the beginners miss this. Don't compare this quarter to the one right before it. Compare it to the same quarter the last year. Which means if you're looking at June 2025, then you should compare it with June 2024. And why do you do this? Is because most businesses are seasonal. A retail company, for example, will always make more money on the holiday quarter compared to versus the quarter in the summer. So this year-on-year comparison cuts out the seasonal noise and shows the true growth trend. Now, what counts as a good earnings growth? So the book says you want to set a minimum bar for this. The book literally says don't touch stocks unless its recent quarter's EPS is at least up by 18 to 20% over the same quarter last year. Many experienced traders raise that bar to even 25 to 30%. In really strong markets, the best performers often show 40% to even 500% plus earnings growth. And for extra safety, make sure the last 2 quarters both show strong increases. You've got thousands and thousands of stocks to choose from, so why settle for an average stock, right? The book says that the real magic is in the accelerating growth. So let's cover this part too. It's not just about the big growth, it's about the growth speeding up faster as well. If a company was growing at 15% a year and suddenly jumps to 40-50%, that's when the fireworks happen. And these are called the so-called earnings surprises that the Wall Street loves. They often trigger the start of huge price runs. You can also check how often the analysts are raising the earnings estimates or whether past results have beaten expectations. That is another clue that the momentum is building. Now, the book also says not to be fooled by misleading numbers. Some companies brag about record sales, but that doesn't mean much if the profits aren't growing. For example, if the sales are up by 20%, but the earnings per share are only up by 5%, that means the margins are shrinking, and that's not healthy. Also, you gotta ignore one-time gains like selling real estate. Those do not count as true repeatable profits. So here, you always have to ask yourself, how much are earnings per share up compared to the same quarter last year? Now, sales growth matters too. Strong profits need to be supported by strong sales growth. If sales are flat but profit jumps, it might be cost cutting, and that is not sustainable. A good rule of thumb out here is look for sales growth of at least 25% or at least least steady acceleration over recent quarters. Because when both sales and earnings rise together, that's the kind of strength that fuels the biggest stock moves. Now also know when the growth is slowing. Just like accelerating growth is a good sign, a deceleration can be a red flag. If a company that was growing earnings at 50% suddenly drops to 15%, and it happens 2 quarters in a row, that's usually a sign that the growth story is breaking down. Even great companies can have one slow quarter. That's fine. But 2 straight slowdowns, that is the time to be cautious. So the final rule, how do you see for your stock selection is, your first filter should always be current quarterly EPS up at least 25 to 50% year over year. The biggest winners often show 100% to 500% or more. A weak 10% increase will not cut it. So when you're hunting for great stocks, only the strongest earnings and sales growth truly matter. Now in this video, we have covered the C of the Canslim, and in the next video we are going to work on the A, which is the annual earnings increase. So see you guys in the next one.